Even as the market has broken down from the daily balance area here, which, don't get me wrong, is definitely bearish, we have been getting some fairly mixed signals as to what side of the trade is in control. You'll know exactly what I'm talking about if you're watching Thursday intraday specifically. For the most part, I think that the tension can be attributed to the battle of the timeframes between the weekly uptrend and the new daily downtrend, which in theory could resolve as soon as this week. Notice that the lower edge of the weekly expected move here is in alignment with our weekly key level for the higher low at 390. We'll be discussing this and more, some other divergences at play, in today's episode of the Weekly Watchlist. Of course, anything that we're associated with is linked down below in the description. Quick thumbs up before we get started is always a great way to support the channel. With all that said, let's dive right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. For structure this past week, we've certainly got a solid red-bodied bar with very minimal upper and lower wick to read into, so nothing really going on from a psychological perspective. Fairly weak close at the bottom of the trading range here. It's quite clear sellers are in control from a structural perspective. From a location standpoint, on the bar-to-bar count, we have produced a sizable lower high as well as a sizable lower low. This also strikes me as being more bearish than bullish, clearly. We'll recall that we had a double inside bar set up here. We've broken the bottom of the inside bars, and we've also closed, which is noteworthy, underneath the low of the green container bar. Once again, that does strike me as being more bearish than bullish on the weekly time frame. We've closed underneath the weekly 50 SMA, another bearish data point. However, we can throw in some bullish ones. If we take out our resistance trendline, we're coming in for the back test of the resistance trendline. In theory, it should act as support here. We're also sitting at the weekly support trendline, so we have confluence of support from that perspective. And we've also got confluence if we take out the Fibonacci's from the lows up to the highs with our 38.2 bull flag consolidation sitting right at 390 roughly. So for all intents and purposes, let's remember trend, right? We know that we have lows, we know that we have higher lows, we know that we have highs and higher highs. Coming off of the weekly higher high, we've been building the case for a completely reasonable pullback to search for a weekly higher low, which of course would imply that the daily trend needs to flip down. And that's exactly what we've been seeing and why we've been talking about this tension over the past week's worth of trade. Recall that the key level, as we've just built the case for, is 390, and we're also getting confluence from a volume perspective. If we take out the volume profile, recall that 390 is the high volume node. So the market should be drawn towards this area. We've rotated through the low volume void towards the high volume node. That's where buyers should in theory step up. Now, because we're in a weekly uptrend and because we're still above this level, we're keeping an open mind to bullish outcomes here. If we break down underneath it, we will of course change our tone. But as of right now, the market is still above, and the daily time frame chart, as we'll see in just a moment, could potentially be looking for a bit of a bottom. If we are drawn towards the upper high volume node here, just note that it would be a weekly equal high, closer to 418, 419, 420, keeping the weekly uptrend alive as well. The biggest thing to watch out for this week is really from the weekly perspective, do we hold or break down underneath 390? Moving on down to the daily time frame chart, let's first evaluate the weekly expected move. If you're not familiar with this, top right hand corner's got you covered with a brief tutorial. Overall, if we're contained by the upper edge of the weekly expected move, the number is 404, it would be a lower high underneath the overhead balance. You could think of it from a pattern perspective as a break, retest, and then continuation in the downward direction. That, of course, is bearish. If we're contained by the lower edge of the weekly expected move, on the daily chart, it would suggest a new lower low being produced, but recall from the weekly analysis that it's right at the key level of 390. So keep an open mind to reversals off of the lower edge of the weekly expected move, and when and if we get here, I would not be fishing for new money shorts. That's how I would think about expected move this week. Definitely a bit more bearish than bullish. If we think about trend, the overall count is definitely down. We have highs, lower highs, and along the way we've got lows, lower lows, lower lows, and lower lows. We've basically produced the lowest of lows in this current sequence on the Friday session, so therefore, just like the weekly trend can afford a higher low because of the higher high, the daily trend can afford a lower high because of the lower low, which would imply that there could be a counter trend type move in the coming week's worth of trade. And to me, this makes complete sense because we know that we have a hammer candle from Friday's session at a key area of support. 393 from a structural perspective was support, was resistance, was support in the past as well. So structurally important, we've got ourselves our daily 200 SMA, the green moving average on your screen. From a pattern perspective, whenever you break a balance area, you typically look to double that range. We basically hit that target to the T, and then you would look for some kind of reversal or possibly counter trend move that's adding up with the hammer candle, right? And last but not least, if we take out the Fibonacci's from the low up to the high. I'm not moving the goalpost here. Recall that the 38.2 was bull flag consolidation when we were looking at this pattern. And I will say that yes, being underneath is bearish. But the next key Fibonacci that we always monitor is the 61.8. And that's directly providing confluence of support with Friday's low. So if you're a bull looking for a counter trend move in the coming week's worth of trade, you need to see Friday's low hold. And I think that there's a strong case to be made that it does hold because of all of this confluence of support at 393.50. Now, let's take a look at the hourly time frame chart, because this is where things start to get a bit more confusing, as we were alluding to in the intro, that tension between the weekly and daily time frame chart. Tuesday's selling, significant, strong. We know that from the internals. Wednesday, kind of digestion. But look at what takes place on the Thursday session. This is where the confusion sets in. If this were going to turn into a hourly double bottom, we technically broke the neckline on the gap up there on the Thursday session. We got some acceptance above for about an hour, completely fall apart, and this is where things get wacky. We made a lower low on the Thursday session. So why was it that into the afternoon, the sellers allowed the buyers to recapture the neckline and have this, face-ripping rally into the close? Now, granted, there's a little bit of pullback happening here. We technically closed back down underneath that level, but for all intents and purposes, that was a wacky move. If sellers were going to make a stand, if this was proof that the buyers had failed to hold over that neckline, we should have closed out for bear flag consolidation, then continued into the Friday, whatever. Didn't happen that way. And obviously, we've got to deal with the cards we've been dealt. Friday's session is interesting as well, because there's a stand in the morning in the downward direction, then it's a grind into the close off of that key zone. So once again, I think something interesting for a counter trend rally only can happen if we take out this key level at 396.75. You're looking for a rotation into $400.75. When and if we get here, you're reevaluating. Is this where the lower high is going to form? If so, if you start to see signs of rejection there, great. Look to trade the daily trend in the downward direction. We'll look for continuation. If it pokes through, once again, looking for a lower high off of 404.50. This is the bottom end of the daily balance. As a matter of fact, let's go back to the daily chart and recall that any sort of lower high here, playable. Any lower high here, playable as well. That keeps the daily downtrend intact. Now, what do the bulls want to see? If there's going to be a significant reversal, if the weekly trend is going to get back in favor of the bulls, if this is all the pullback then we're going to get, it's got to be a higher low over 404.50. Because the weekly expected move is suggesting that we're contained underneath that level, I don't necessarily think that the daily trend is just going to magically reverse back in the upward direction in the coming week's worth of trade. Once again, I think over Friday's high, 396.75, we can see a counter trend type rally, but it's still a daily downtrend as long as we're underneath 404.50. If the bears just get outright continuation, so we see consolidation here and then a breakdown underneath Friday's low at 393.50. Once again, we target the weekly level at 390, and then we reevaluate. Are we going to find a weekly higher low? Are there signs of the daily time frame chart bouncing? Or are we just going to blast right through it? In which case, we would significantly reevaluate our take on the markets right now if we fail that weekly level. So that's the roadmap for the coming week. Let's take a look at some supporting evidence. Exhibit A, market internals. If you're not familiar with this screen, top right-hand corner's got you covered with a brief tutorial. I want to reinforce the idea that all of the damage was done on the Tuesday session. Big volume outflows here in terms of the advanced decline line being over-correlated in the downward direction and a nasty cumulative build on the day's session. But if we look at what took place throughout the remainder of the week, it really wasn't like the sellers continued to aggress in the downward direction. Again, here's Tuesday's low. Look at how we closed the net outflows on the week, barely making a lower low from a volume perspective. The advanced decline line corrects the over-correlated state and then starts an uptrend on the Friday session. Don't get me wrong, it's definitely got a bearish edge here, but it's not like it was on the Tuesday session. Tuesday was where the damage was. Same thing with the cumulative ticks. Notice that all of these are neutral here and barely even make a dent as to what took place on the Tuesday session. I would go one step further and even say that as the Thursday morning sell-off was taking place, the cumulative tick hardly even got negative. So once again, are the sellers running out of bullets here? It seems likely, and on Friday's session, we know that we printed a daily hammer candle. I think with these internals sort of saying, hey, damage was done early, but that's kind of all we've got as of right now. I think it's worth keeping an open mind for a counter trend type move. Once again, there is a bearish edge to these internals. Don't get me wrong, but they're not as bad as they could have been considering the price action we have at hand. Exhibit B, market profile. If you're not familiar with this one, top right-hand corner's got you covered with a brief tutorial. The main day in question is, of course, Thursday yet again. Notice that your value area on Thursday is overlapping to up from the Wednesday session. The point of control has definitively closed higher than the Wednesday point of control and the Tuesday point of control. What does that tell us about the sellers down here towards the lows on the breakdown of the Wednesday low, simply not willing to put in price acceptance at these lows, and instead the point of control, the most value, is higher in the overall profile. Once again, we know that we had a gap down on Friday due to the PCE numbers coming in hot. Perfect normal distribution, not a trending type day on the Friday session. Point of control is smack in the midpoint of that profile, telling us to keep an open mind that if we break out over Friday's high, Friday was a hammer candle, right? If we take out that high, there could easily be a reattempt at the VPOC at 40.20, which is roughly in alignment with these two equal daily highs around 40.30, or as we know on the SPY daily time frame chart, $400.75. And when and if we get there, we are certainly looking for the lower highs. But once again, everything about this chart and specifically the point of control from Thursday would suggest that a counter trend rally could be on the books, and this would be a reasonable target from a daily trend perspective looking for the lower high. So everything about the market profile is sort of aligning with what we've seen so far based on the internals and the price action. Next up, let's have a look at the weekly performance of our S&P sectors. Notice that the XLE for energy led the pack here, up 0.64%, which is not ideal considering it is D for defensive in nature. At the bottom of the barrel is real estate, down a whopping 3.22%. The concern there is that rates are going to continue to move higher and likely stay there for longer. The nail in the coffin was the PCE inflation report from Friday coming in extremely hot. Now, as we know, real estate is a fairly lightweight sector. By itself, it's not going to move the S&Ps. But directly underneath, it was followed by discretionary and communications, both heavier weight risk-on type sectors coming in roughly in that ballpark of being down 3%. Cause for concern there. Of course, the XLK tech sector, heaviest weighted sector of them all, not as bad, but it certainly did not escape unscathed, down 1.35%. Let's check in on the structural charts and evaluate what's going on from a trend perspective, noting that the posture isn't necessarily fantastic out there. Here's energy coming into the bottom end of the daily/weekly range, finding a little bit of support here. This is a weekly hammer. I would just be mindful that it's not the end of the world if it breaks down under the low end of the range at 82.67. It would actually become more concerning if it's acting as a leader, getting price acceptance up and over 87.54. For this upcoming week's worth of trade, I want to see it stay in this box right here if it's going to be a rainbows and butterflies type situation. Next up is the XLB for the materials sector, really lightweight, so we'll keep it extremely brief. Here's a weekly balance area. There's the midpoint. We're close to the midpoint. Therefore, we don't really have much of a directional edge. It'll become more meaningful from a bullish perspective if we can take out the top of the range, 84.25, and more bearish if we obviously take out the lows at 77.50, give or take. Moving along to real estate, this as well as a lighter weight risk off type sector, but the weekly trend is currently up. We know that there is the competition of timeframes on the SPY chart itself, and this would fall in alignment with those ideas. In this overall box right here, it strikes me as being fairly neutral. Don't get me wrong. In all of these instances, bearish pressure is still bearish pressure, but in the lightweight sectors, it really requires breaking a larger pivot to have more of an influence on the S&P itself. So that number is going to be underneath 37.25 or really back above 39.85 currently. Strikes me as more neutral for our market. Next up, XLY, heavier weight risk on type sector. Let's just briefly break it down. We've got ourselves a balance area here. We've got overhead supply. We rejected on the retest of 148 on the initial go, but we are finding a little bit of hammer support on Friday session at the top of this overall gap. So in a picture perfect world, the weekly trend remains up with lows, higher lows, and higher lows if we turn for support here and can get back above 148. That is the key level here in the XLY. It's got to prove it to us, getting higher highs back above 148. The cause for concern from the bearish perspective would be a lower high underneath and an equal low reattempt. Now we're talking about an H pattern, completely rejecting the overhead supply, and a breakdown there threatens the weekly trend. So it hasn't done it yet, but as of right now, 148 is the key number to watch. Obviously blasting lower here, big cause for concern. It goes without saying that that would of course be bearish for the S&P. Next up, communications. Look at this from a weekly perspective. Just kind of imagine this for a moment, right? We can easily find a weekly higher low, lows, higher lows, higher lows, looking for the higher low on the weekly chart above 52.17. With the hammer candle from Friday, I would say very similar things to the XLY. It's do or die time. We want to get back above 54.30, and if so, that's slightly more bullish than bearish. If we break down underneath, that is a cause for concern, and we will change our tone. Next up is the XLU for utilities, also a D for defensive and risk-off type sector. It is completely lagging the market, which is exactly what we want to see. It's not providing leadership up and over this 71.85 level. As we move forward into this upcoming week's worth of trade, I would primarily focus on this range. It would start to exhibit a little bit too much leadership for my liking if we get over 69 in utilities, hanging out underneath here, going sideways, even dribbling lower to this next support at 65 does strike me as fine from a risk-on, risk-off type posture. XLV, lots of comments to be made here, noting that we are breaking down aggressively and through a potential area of thin structure. Remember also that this is the second heaviest weighted sector in the S&P 500. So if it's going lower, if it's going to repair all of this thin structure and make the reattempt to 125, you better believe it's going to be bearish pressure for our S&P. Now, recall also that it is more D for defensive from a posturing perspective, regardless of recession or not. People will always need healthcare, so that's kind of the thinking behind that. So it's not the end of the world if it does not just dramatically do something like this. We just want to see the bleeding stop, so to speak, in the XLV if the SPY is going to have any opportunity for finding a weekly higher low and potentially reversing on the daily time frame. If this continues to move lower, we'll treat it as bearish pressure. If it starts to backtest 130.50, all eyes on that level. A lower high underneath is concerning. Breaking back above, a little bit more constructive from the bullish perspective. Next up are industrials, 8% of our S&P 500, getting some price acceptance underneath $100.50. But if you think about this as an overall range, once again, we're very close to the midpoint. It's pretty difficult to say whether or not bulls or bears are in control of this particular chart. Ideally, from the bullish perspective, we get back up towards that 103 level. From a bearish perspective, you get intra-week bearish pressure and reattempt the bottom of the range at 96. Given the fact that we've got a hammer candle here, looked underneath Thursday's low, closed back inside of Thursday's range, inside of Wednesday's range, it's back testing the 50 SMA, I would be open to bullish outcomes getting back above $100.50 early on in the coming week. Next up is the XLK tech sector, certainly worth spending some time on here, breaking down from the overhead balance, doubling that range and hitting that target at 135. It's do or die time. It also represents the prior top of resistance area from in here and where we've already seen a break and retest for support. So bulls, you got to hold on to 135, keep us sideways, if not potentially poking back into the overhead supply. Bears, break it down underneath 135 and kudos to you. You're making big progress in the downward direction. Based on Friday's price action, I'm not thrilled about it, right? This is an indecisive doji. Gap fill reversal on Friday, spending more time underneath Thursday's range. Thursday was an attempt to get a higher low and higher high above the Wednesday range. It just didn't materialize in anything back over 139.25. So I'll give it the benefit of the doubt. I'll stay neutral in here, bullish above 139.25, bearish underneath 135, no doubt about that one. The structure does not look ideal for early on in the week, having bullish outcomes. Next up is XLF for financials, breaking down underneath that key zone at 36. The entirety of the week was spent underneath. Strikes me as a bearish step in the downward direction, of course. Bulls want to see a recapture of 36, and then we're just neutral in here, getting bullish on the equal high break if it happens over 37. And bears, any lower highs underneath 36, any continued rejections here for things that look like this, of course, bearish pressure intra-week, looking for 34.50 on the downside. Last but not least is the XLP consumer staples. What do we see over here? This is D for defensive. It's a lighter weight sector, but still a little bit heavier than utilities and energy, kind of hanging out in the midpoint of this overall range. Friday did produce a hammer candle, breaking over Friday's high. I would just look for reattempts of 74. If it starts aggressively breaking over 74, a slight cause for concern in the markets from a leadership perspective. But remember, at the end of the day, bullish pressure is bullish pressure, bearish pressure is bearish pressure. If it does perk up, maybe it's at least enough to keep the S&P neutral. From a constructive perspective, though, wouldn't be great, noting the sectors that would be leading that potential rebound. From a risk posturing perspective, the ratio grid continues to be a great visual. If you're not familiar with how to set this up, top right-hand corner's got you covered with a brief tutorial. The top four are the risk-on type sectors, and notice that all of them continue to look fairly good, barring healthcare, right? The XLK tech sector is in a clear uptrend with higher lows, and it's putting in consolidation well above an upward sloping 50 SMA. The XLF, although it did break down underneath structural 36, has broken a resistance trend line here and is sort of pushing away from the 50 SMA in the bullish direction. The XLY is certainly putting in bull flag consolidation, bull pennant consolidation, which does strike me in these three as being more risk on as opposed to risk off. The XLV is attempting to get above a double bottom neckline, although it is still significantly below a descending 50 SMA. So overall, the take is not so much that risk on has deteriorated, but rather that risk off is actually perking up by just a little bit. Notice that the XLP for consumer staples is underneath a descending 50 SMA. The same thing in utilities underneath a descending 50 SMA, although perking up off of the lows. Same thing can be said about energy, trying to produce a double bottom, but still far off of the neckline and daily 50 SMA. So once again, the takeaway is that risk on is still out there, but risk off is starting to come slightly back into the picture in a little bit more of an aggressive stance. Now, if we take a look at the XLY over XLP, so growth versus value, we'll notice and recall that this is breaking down underneath the lows of what was bull flag consolidation here with a lower high underneath. So intra-week, of course, downward pressure would get us into the 50 SMA and this gray bar here where we're looking for a weekly higher low. Recall that this level is important from the prior support, which then turned to resistance in here. And we would note that it is a strong higher low above what was set in late December of last year, and also the 50 SMA. So once again, this does strike me as intra-week bearish, but constructive from the longer time frame perspective. Having a look at the dollar, we'll notice that we have produced an equal high now. So the daily downtrend is over. We're in either a neutral trend here or the beginnings of a new uptrend. This, of course, is concerning because if we can break over 105 in a significant manner, you could start to think of this as an inverted head and shoulders, and moving back up towards this area around 110 would of course produce some bearish outcomes in equities. A reason to believe that the bullish outcomes could continue in the dollar is because if we take a look at the gold contract and have a note at where we're at from a relative perspective, right, the dollar's already trading here, gold has some room to fall. So if gold has to make that equal low to these prior lows from this area, it would of course imply a much higher high out of the dollar, confirming an uptrend and once again, putting bearish pressure on equities. So that is a cause for concern as we move into the coming weeks worth of trade. Let's have a look next at the TNX rates and see what's going on from this perspective. And we'll just continue to remind you that this weekly double bottom is breaking out with price acceptance above the neckline at 3.88 in the 10-year. As of right now, you could think of this as bull flag consolidation. And if we break, obviously it should mean bearish pressure for equities. And if we pull back, there's still a strong opportunity for now a weekly higher low to form, right? We've had these equal lows here, here, and here. If we pull back, now there's an opportunity for a higher low anywhere above 3.6, which constructively would be bearish for equities in the long term. So keeping a close eye on that. And we know that this also aligns with what's going on with PCE. Nothing new from the Fed tracker, continuing to reiterate lower probabilities of a 25 basis point rate hike and increased probabilities of a 50 basis point rate hike. However, I would remind you that although this is in alignment with the PCE data, it came in extremely hot, and there are numerous people pounding the table for a 50 basis point rate hike, it's very unlikely that Jerome Powell would do what the market is not expecting, which is currently a 25 basis point rate hike. And instead, what he would do to combat the inflation that's seemingly having a resurgence would be to go out and say something like, hey, we're not planning on cutting rates at any point in the future, and the market is starting to get that message, not pricing in any rate cuts into the end of 2023. Instead of looking at earnings this week, which we know were an absolute disaster for Q4 of 2022, let's take a look at the consumer, because the consumer is ultimately going to fuel the next round of corporate earnings. And what we see is starting to become slightly alarming. You've probably seen this headline that we're approaching rapidly, $1 trillion in outstanding credit card balances, and the next most logical question would be, are people actually defaulting on their loans here? Are we going to have a credit event? And if we take a look at delinquency rates, the answer is alarmingly, actually, yes. People are increasingly defaulting or being delinquent on their loans, which is a massive cause for concern, because if those people go bankrupt, or just in general, if we start to see decreased consumer spending, which I totally understand is contrary to the last report we got, that would be a massive hit to corporate earnings as we move forward through time. Now, let's be abundantly clear. This has nothing to do with what you should do when the bell rings at 9:30 on Monday's session. This is a much longer time frame thought on whether or not a credit event could fuel the next leg lower if we remain in a weekly bear market and we fail underneath 390. The business cycle chart also has no bearing on what we should do as the bell rings at 9:30 on the Monday session. However, I want to point your attention to the DBC commodities in the lower portion of the screen here. It's still stuck in a descending triangle, which as we know is a bearish pattern. And if we break down underneath these equal lows, it would be a big force for deflation. This goes counter to the narrative that inflation is rebounding, it's going to spiral out of control. If this pattern breaks down, it is worth keeping an eye on. From there, we would want to see TLT bottom, and then we could look for a more constructive low to be put in the S&P. Once again, not what we should watch on Monday at 9:30, but speaks to the overall narrative and having two sides of every story. How about the TLT bonds? Any flight to safety trade going on here? Not really in the grand scheme of things, still underneath this congestion and consolidation. But if we zoom in from the more nuanced perspective, it is worth pointing out that as equities had pulled back, there was a slight outperformance from the bonds. Tells us to keep an open mind about just blatant downward continuation and flight to safety resuming in the markets. It would become much more meaningful if we started making highs in the ratio pair up around 0.28. Something on the flip side of this coin, though, is the bullish divergence that's taking place in the HYG, typically referred to as smart money versus dumb money. It never took out this 7250 area. This was a big concern that we were mindful of. Didn't happen. And instead, we're producing a bullish divergence with a higher low on the Friday session, whereas equities certainly made a lower low. This would speak to improved odds or increasing the probabilities of the outcome of that counter trend rally we described on the SPY analysis. Very briefly, let's take a quick look at Bitcoin. Take this with a grain of salt. All I want to point out is that we're still above the breakdown candle high, and holding this as a higher low speaks to improved risk appetite for our market, which again, open mind, maybe it speaks to bullish outcomes in equities as well. Some of our market breadth indications are flashing warning signs like new highs versus lows being at the zero line. Of course, the threat here is that we transform into more of a bearish look like what we experienced in 2022, or the more optimistic take is, hey, we bounce off of the zero line, use it as support, and then look for bullish outcomes. We can't really say anything one way or another as of right now, but it is a warning shot, and we'll learn something in the coming weeks worth of trade. Next up, we could take a look at stocks above their 200 SMA in the S&P 500, and although it did deteriorate in the last week's worth of trade, it is still above the 50% mark, so that strikes me as okay. It's not great, obviously. I'm not saying it's a bullish data point, but it's not the end of the world just yet. More than half of the companies in the S&P are above daily 200 SMAs, but more than half of companies are underneath daily 50 SMAs here in our SPX A50R. That is more of a cause for concern and would speak to improved bearish odds in the coming weeks worth of trade. If we recapture it quickly and we get a look that looks like this, a little bit more constructive, but as of right now, definitely not making me feel warm and fuzzy about bullish outcomes. Let's take a look at our equal weight RSP. What's going on with this? We know that we've broken down underneath this breakout point even in the equal weight. Now it's all about whether or not the equal weight backtests and rolls over here, or if we backtest and poke through. That'll tell us something about markets. As of right now, again, nothing to read into, but if we get the counter trend move, we'll take a look on the Wednesday session. Next up, we'll take a look at Dow transports. Are we still experiencing the divergence here? Absolutely. Notice that we're sitting on the lows and this is still elevated. The equal low would be somewhere around here. What is that? 13.3, give or take, in the transports. So this did not hold. We did not hold up above this breakout point. This higher low did not hold. So right now, this is telling us to keep more of a neutral mindset, considering that this is not quite at the lows. Just because we had an upside divergence does not mean that we can't have a downside divergence, right? If this stays in the box, or I should say starts to threaten a breakdown, but the transports are saying, hey, we're just staying stuck in this box doing this, then just like we didn't believe the breakout here, we also should not believe the breakdown here. They need to be moving in sync to really confirm a move one way or another. Having a look at volatility, we're certainly still above 2050, but the most interesting part about this chart is the fact that equities made a lower low from a gap down on Friday. You would have thought that VIX would have perked up there. It certainly did not. It actually made a lower high on the daily time frame chart. Much more indicative of, hey, this is just a reasonable pullback on the weekly time frame. We're looking for this uptrend to continue. The next step from a volatility perspective would just be to get back down underneath 2050. If the market is going to put in more of a capitulation type sell-off and fearful type move, you would see VIX rapidly start accelerating over this high. Didn't even happen on the PCE gap down. So it strikes me as being more comfortable as opposed to uncomfortable, regardless of being above 2050 or not. Of course, that could change on a dime, but so far, so good. The volatility of the volatility index would kind of confirm that look, coming back in towards the midpoint of this range instead of breaking out up and over the top. And volatility futures are still certainly in a strong contango, which is indicative of present day risk being greater than future risk, which is what money managers want to see from a volatility perspective to allocate capital. So downtrend here, coming in the week's worth of trade, coming in the week's worth of trade. Both of these things strike me as more comfortable comfortable as opposed to uncomfortable. Finishing up the remainder of the broad market with the QQQ and IWM, notice very similar things about the weekly expected move here. If we do see a counter trend rally, it would be a break up and over 293.15, and the target would be a lower high around 297.75. If we break above that, that would be slightly interesting, offering up the opportunity for a higher low above, much more meaningful and closer, well within striking distance as compared to the S&P. If the bears are going to put in consolidation, it wants to stay underneath 293.15 and then break this low at 289.75, break the daily 200 SMA to rotate to the weekly level of interest at 281.25. Next up is the IWM Russell 2000 and the small caps, much more indicative of a risk appetite for our market. Zooming in here once again, kind of struggling, a little bit different than what we've seen in the S&P and even the QQQ. Green-bodied hammer on the Friday session, getting back inside of the 2-bar range there, struggling to get price acceptance underneath what once was a prior area of resistance, turning into support. If the market rallies here in the IWM and can recapture 189.75, strikes me as a much more meaningful look for risk on resuming in this market and sort of treating this as just a very mild pullback. The bears, you really got to keep prices underneath 189.75. I would say that, consolidation here, maybe it's building out as a bear flag, but on a relative basis, this is actually holding up better than what we saw in the SPY and the QQQ. SPY and QQQ have tested this low, are trading at the daily 200 SMA, not the case in the IWM. Finishing it off with some weeklies side by side, just to count trend, we've got lows, higher lows, highs, higher highs in the SPY. We know that 390 is our next key higher low. In the QQQ, we've got lows, highs, higher highs. We are in an uptrend. The key low that we want to hold is right around 280, still offering up a weekly higher low. And even in the IWM, we've got lows, equal lows, highs, higher highs. The ideal pullback is, anywhere above 180. This one is still trying to hold on to the neckline of the double bottom pattern. So overall, structure is not quite giving it up yet on these higher time frames. It's the tension between the weeklies and the dailies that we've walked through in today's video. If you've made it to this point in the video, I'm sure you're enjoying the analysis. Hit the thumbs up button and subscribe to the channel so you know every single time a new video comes out. And with that, we will dive into Apple. So just like the SPY, just like the Qs, finding a daily hammer candle on the Friday session. If we can crack back above the 2-bar lows, above Friday's high, we're just looking for a counter trend move into these equal highs at 150, and then searching for a daily lower high that then reverses trend in the downward direction. We have fallen out of this overhead balance area, so we're searching for break, retest, move lower, right? If we do just get downside continuation, it's got to be a target of 142. And if the bulls are going to make something substantial happen here, it's got to be a higher low above 151, taking this one in stride. Next up is Netflix. Just remember the overall strength of the daily trend here and ipso facto the weekly uptrend as well. Searching for excuses for higher lows. Now, the Friday session is bearish acceptance on a 3-bar play towards the lows of Thursday's move. And that doesn't strike me as all that comforting, noting that buyers tried to step up here at this area of support, and on Friday's session they just couldn't really make anything happen back up towards that high of the Thursday bar. So watching for a flush of these two equal lows, but I would this would be the picture perfect situation, right? We flush the lows, trap a bunch of shorts here, pop back above, find a higher low above, and then it's back off to the races. My first target would be here at 332.50. I would love to trade Netflix in the upward direction based on a pattern that looks like this, and then possibly just look for the retest of 350, noticing again the strength of the weekly and daily uptrends here. So not getting overly aggressive on the short side, really thinking of this as the opportunity for a fake break. If it does want to put in some sort of lower high here and then roll over, it's a different story and we'll take that in stride. But as of right now, watching for a flush of the lows and seeing if it can turn into a fake break. If it does continue, target's 298. Of course, it's got to provide an intraday reversal pattern if you're going to try to catch the quote unquote falling knife. Next up is Tesla. What's going on with Tessie? Certainly putting in a hammer candle on Friday's session, really hammers all week. It was Wednesday, Thursday, Friday here, closing inside of the Thursday range for the week as well. 197.50. I mean, just relentless. The sellers can't really make anything happen underneath that area. I would be cautious in this zone here. The big breakdown is really underneath 182.40. And I would look at this, I would start to think of this, a little bit of a glitch there, sorry. Look below and fail, right? Target the top end of the range here at 213. The better bullish breakout is just clearing 213. Then your target is 227. Next up, we've got Google. What's going on with Google? Head and Shoulders continues to pan out. Bearish pattern underneath that neckline at 94.25. Strikes me as bearish acceptance on the Friday session as well. Looking for lower highs, so either consolidation here and then a breakdown, or lower high up against 92 and looking to position short against 92 for the rollover and equal low here. That would also be a 100% retracement. When and if we get there, look for a more meaningful weekly lower high dead cat bounce. So pretty bearish on Google based on the daily structure. Next up is Meta. What's going on with this? Gap down on the Friday session, but it didn't really follow through any lower. Now we are in a downtrend with highs, lower highs, lower highs, lower highs, and technically we've produced a lower low. So can it afford a lower high? Absolutely. Want to see it stay underneath 173.75 for this gap close to continue to be on the table from the earnings cycle. That's at 153.65 with an intermediate level at 161.89. Friday's session, again, quite interesting. This past week of trade was really wacky with that Thursday session, down and up, and then Friday's gap down with PCE. It's still in bearish context, but a green bar there. It's not like the sellers are stepping up aggressively on this flush. There was no follow through. So I just sort of want that extra confirmation. If you're looking to play intraday trades, of course, if you're a day trader, make sure you get that extra step of confirmation with the confirmed lower high or the break of an equal high before really loading up on any particular move in this, at least in the current market environment based on last week's trade. Next up is NVIDIA. Really kind of carried the market and held it neutral with this big gap up from the earnings call. Again, all you've got to do is mention AI, and the next thing you know, your stock is going to the moon. Anyways, the fact that it continues to hold the gap up and continue to respect the prior top of what was turning into a weekly bull flag really strikes me as impressive. So as long as we're over 229, looking for bullish outcomes over 238.25, the two-day range here, of course, breaking down underneath, we've got some thin structure, right? This red bar, a little bit of a gap there. I would target the intermediate stage of that range at 217.50 as a first downside target and then reevaluate. Breaking these highs, just to give you an idea of where that upper target is coming from, it's a prior gap in the chart. If we do something like this, you can see it off to our left. That's 250.250, fills up to 258.25. Next up, Microsoft. What's going on in the world of AI? Speaking of AI, getting some price acceptance underneath the three equal lows at 250.75 does not strike me as the most bullish look in the world. And noting that this, as an overall balance, did not produce upside outcomes when we closed inside on the Thursday session, I've got to be a little bit more bearish than bullish on Microsoft, looking for that continuation in the downward direction to 242.25. And if it wants to go further, so be it. 234 is up next. If we are going to rotate back into this range, once again, think about confirmation, think about the wackiness of the market in here. It's got to be a higher low above 254.50 before changing our tone to having more of a bullish stance inside of Microsoft. You could make the argument that, hey, we've got a trend line here. We're kind of bouncing off of it right now. Still need the confirmation. Want the horizontal confirmation above 254.50. Last but not least is the mini beast. We've got Amazon and a couple trade ideas for you. Strikes me as more similar to Google, honestly, with the head and shoulders type pattern panning out here. Beautiful lower high underneath the equal low flush at 96. Inverted, or not inverted, but rather just a doji on the Friday session here at the target, coming in for that equal low around 92.25. So this one's simple. You're waiting for bearish consolidation to build out a balance area in between these two levels, then play breakdowns, right? Because we are in the bearish context of a head and shoulders breakdown here. So underneath 92.25, 90.10 is the target, then 87 from back down in here. If the market is going to put in a major reversal and find a higher low, it's got to be above 96, and then we'll consider bullish outcomes back up towards 101.50. As of right now, this does strike me as slightly more bearish than bullish. Quick reminder to hit the thumbs up button, the subscribe button, the bell button, all that good stuff. And let's dive right into DFS, Discover Financial Services, for our first trade idea. Bullish engulfing candle on the Friday session. We'll recall that from a ratio perspective, financials did start to outperform on Friday. Looking for follow through from this engulfer to retest the flush point at 114.35. We currently closed at 112.25. So about 2 points of overhead room to run. When and if we get there, being very mindful that a lower high could produce a daily downtrend continuation type look. So quick scalp looking for momentum out of DFS. Next up is another D stock, DVN, for Devon Energy. Taking a look at what's going on over here. Remembering that the energy sector is at the bottom of its daily balance range. If the energy sector as a whole bounces off the bottom, I would expect that Devon could break the two equal highs here and come into the target at 57.30. That's of course your high from the I don't know what day that was, but the session from there. And you can see intraday how there was a bit of a rally and then we faded off of that area. So 57.30 is the target. After that, skies are kind of opening up here, thin structure, and of course a gap to close up towards 61 roughly. Let's go on to our last trade idea here, ABBV. ABBV, what's going on? This tends to be an outperformer in the healthcare industry specifically. Obviously, healthcare is not doing so hot right now, but just building out a big balance area from this earnings cycle in the past. If we can crack the top of this range, look left, thin structure coming into the back test of this flush point here at 160 offers up about 6 points of overhead room to run. So thinking about ABBV as a break over 154, intraday scalps in the bullish direction, swings in the bullish direction here. If it never breaks 154, not interested. Obviously taking out the lows, run away. Not interested in this trade whatsoever. That's going to do it for today's episode of the Weekly Watchlist. If you enjoyed the video or learned anything new, let me know down below in the comment section or by giving the video a thumbs up. Don't forget that we will be live tomorrow morning at 8:30. Hope to see you there. And I wish every single one of you a green trading week.